What's up, guys? This is Rustic from Rawstocks, and I had some questions lately, and those questions were, Rustic, how do you place an options order? So some of you guys have been trading stocks for a little while. You haven't been in the options game. You see people making money in options. You decide you want a little piece of that action, right? So today we're going to look at Robinhood. We're going to look at Tesla. We're going to look at how you would place a options order. So let's jump into it. On the screen, we have the Tesla options buying area, right? And by finding that, you just go into the stock that you're interested in looking at, trading options. You click on trade, you click on options, and then you can find this window here. So in this window, you can see we got Tesla. Currently, it's selected to buy a call. Okay, and so here we are on the buy, here we are on the call, here we are picking our expiration date. You can select from many different expiration dates all the way down to January 16th, 2026. We're just going to look at this week's contracts, which expire in 4 days from now. We're in Monday's trading session, and we are going to look at how to place a call option here. So over on the left side, we have our strike price. You can see the strike price changes every $2.50, and those are the contracts that you can buy. It tells you what your break even amount is. It tells you the percent that you need to get to break even. It tells you today's percent change on that particular contract, and it tells you today's dollar change in premium on that options contract. On the far right here, you have your premium listed, and that's going to be how much your contract costs times 100, because the options contract is ultimately an option to buy or sell 100 shares at the particular strike price. So this says $6.10 for this. This is actually $610. Okay, $7.25 premium, so $725. So now, how do you select the right contract? So we can see right here, we have our share price currently sitting at $2.53 or $253.25. And so the next option up, if we were looking at buying a call and expecting price to go to the upside, we have the 255 contract. Currently, premium is at 725 on that strike price. So if we select that contract, it's going to give us some different numbers. It's going to give us the delta, the gamma, the theta, and then the Vega and Rho. The Vega and Rho, I wouldn't be too concerned about. The delta is going to be the price that the stock moves per dollar of the price that the contract moves per dollar of stock move. The theta, also very important, is the rate of decay per day that you hold that contract. Okay, and so if you want more information on how to understand Greeks, there's some great videos on YouTube. There's also some great text that you can read on, Investopedia or different websites that will really give you a good understanding of delta, theta, even gamma, and what those mean in terms of your contract. Now, what I can tell you is further in the money. So if we were to go down here, right, so on this 255 call, which is slightly out of the money, but near the money, we have a delta of basically 50. So that's saying more or less every dollar that the stock moves, you're going to see a move of about 50 cents on the premium of that contract. But if we move down to say a 240, we could see that it has a delta of 77.68 or 0.7768. Right? And the theta is less, so that as the days go on, there's less decay as price moves in the direction of your call. In this case, it's already in the money, but as price continues to go up, your contract is gaining more value for every dollar than if you get this out of the money or slightly near the money contract. Right? And you can see as you go further out of the money, delta's lower. We have a theta decay of about the same. Right? And then we say we go even further out of the money to 270. We have a much lower delta. Theta is also lower, but the overall contract is lower. So I like to say that near the money contracts are pretty good. If you have a very good idea of where price is likely to head during the time that you have the contract, you can take it slightly out of the money. A lot of people get lured into taking the further out of the money because they're cheaper and that's what they can afford. That's not always the best case, because if you have a contract that expires in 5 days and you need price to run all the way to 270 and you don't know if it's going to get there, that theta decay is taking out the value of your contract as we get closer to expiration. Why maybe price is not moving as rapidly as it needs to balance out that decay, but also to get you to the price that you need stock to be at in order to make money. Because if you took a 270, you need price to get to 270, 207 by the time of expiration to at least break even, right? And say we only get near 265, that contract's going to be near worthless by the end of the or by the beginning of Friday's trading session if we aren't close enough, because it's been decayed. Right? So when you do want to take the order, you come over here, you press, you select the position that you'd like, and then it will show on the right hand side that you can purchase that contract. Okay, now oppositely, if you want to take a put contract, which means you're expecting price to go down, same kind of thing applies. We're going to be looking at our share price at 253.25, and if we're expecting price to go lower, we might be looking at the 252.50, which has the puts are going to have negative delta, so this has a negative 0.4532, or again, when price moves in your favor, it's going to be about 45 cents per dollar of share movement. And as we go further out of the money, you see the similar things. Delta going down, it's giving you less for your money, but Delta can adjust as price gets closer and closer to being in the money or eventually going in the money. You can see all the way down here, like at 230, you have only 0.09 for every dollar move, so it's not gaining a lot of value as price is moving in your direction, especially because those contracts expire in only 4 days. So I hope this has been helpful. There's other trading platforms too. Webull has a much different trading platform and experience, but the same information is going to apply. You're looking at strike price. You're looking at what you need to get to break even. You're looking at days to expiration, and then you're primarily looking at the delta and the theta. Anything over 0.5 is going to be a decent delta. Anything below that is going to be more risk. Again, also with theta, the lower the theta is, the less decay that's happening as you hold that. Another thing to watch is implied volatility, and that's the last thing I'll mention, is implied volatility is up when there's an expected volatile move. Currently, we're heading into earnings, so we see a much higher implied volatility. We got like 75% here. We got 73% here. So, there's an expected big move coming up with earnings, so your implied volatility is higher. But what that also means is that if you hold this contract over earnings and that event has already happened, this implied volatility is going to drop. It's going to make your contract worth less just because of that implied volatility drop. So that implied volatility does have an effect on your premium that you're purchasing your contracts for. So if this has been helpful, drop a like, subscribe to the channel. We have some fun things going on with a merch giveaway right now. And so I'm going to drop this in the tutorial section as how to buy options contracts. And I hope it's been worth me covering for you guys. All right. Thanks for tuning in, and we'll see you on the next one.